Ronnie has called us from Montreal. Go ahead, Ronnie, please.
Thank you very much for taking my call. I'd like your opinion on Magna and the NAFTA negotiation, as well as if you would prefer it to Linamar.
Okay.
Thank you very much.
So, Ronnie, very quickly on Magna. Magna, obviously a global business, has lots of business in Europe, is really the largest independent complete vehicle assembler, right? So they're putting whole cars together. They're going to grow that business 25% a year over the next 3 years. They're going to build half the 5 Series BMWs, a lot of Range Rovers as well. This is a quickly growing business. Magna is growing at a faster growth rate than the industry by about 25%, but trading at a discounted earnings multiple to the industry. So it's cheaper, but growing faster. Yes, there is some risk with Magna for sure, but this is a company that returns capital to shareholders. I would be comfortable owning the stock. We do own it as one of the holdings in our equity portfolio. And I think that this is a good way to participate in a stronger global consumer.
Michael is standing by in Calgary. Go ahead, Michael.
Yeah, good afternoon,
Hi,
David.
Hello, Michael.
My question is that I want your outlook and assessment on Alibaba. So the number one question is that if I have the share, should I hang on to it? And if I want to buy some more share?
Yep. So obviously, China's largest global online marketplace that is growing very rapidly. It's not inexpensive. It trades at kind of like 40 times next year's earnings estimate. There are political risks, clearly, because it is in China. Things can happen. We own the stock, and I think that the structural theme of online retail and marketplaces is not one that's going to go away anytime soon. They should grow 50% this year, maybe another 30 to 40% next year, as large it is, and the market just continues to get bigger. So estimates are being revised higher. There's risk of pullback in any of these things, but we own it, and we also own Amazon.
Okay. Michael, thanks for that question. Brian in Beaverton, Ontario, go ahead.
Yes, could I have David's thoughts on Facebook and maybe his comments on today's earnings? Thank you.
Sure. So, the earnings today I thought were quite good. The one thing that people are concerned about is that their daily usage, number of users in the U.S. was down quarter over quarter. So they're going through a change up in their news feed. We think that they have a very large opportunity to monetize this base that they have. And again, the social media theme is one that I think is a long way to run. The stock may pull back a little bit tomorrow, but at this point, I think that we like the theme and we like the company.
Okay, and Michael in Vancouver, fire ahead. Hello, Michael. Not hearing Michael. I think the question was on junk bonds.
Right. So high yield bonds, a lot of people have been in them because the yields obviously are higher. There's higher risk. And since in the last 3 years, the extra return an investor is getting for taking that additional credit risk has become narrower and narrower.
Okay.
People become more and more confident. So, you could get 12% 4 years ago. It's a much smaller number today. In fact, junk bonds in Europe trade at a lower yield than the yield of a treasury bond. It tells you how comfortable people are with this risk.
And
I think they're a little too comfortable, frankly. Okay. So we don't have any real high yield exposure at this point. I don't think we're getting paid to take the risk. In the macro portfolio I run, we are bearish bonds and we're short the bond market. I am short high yield debt as a percentage of that portfolio. So I would avoid it.
We have a quick look maybe at JNK, which we are doing right now. And ETF.com is showing a quote yield to maturity of just over 6% on that one. Okay, but you always want to check how a yield is calculated.
Well, you do, and you have to ask the question, what kind of default rate will you see going forward? I don't think that it's going to be high, but I don't think you're getting paid well for the risk that is associated.
You feel there's a bit of complacency right now. Okay, we're going to be back. We're going to have David's top picks for you next on Market Call Tonight.